Subramaniam, who is joining us on the show right now. A very good afternoon to you, Sunil. And a lot has transpired over the last 15 odd days in the markets. You have the Trump taking oath, almost a month. Trump taking oath, you have the budget, you also have the Federal Reserve meet, RBI meet as well. A lot has transpired, and now this week we are all waiting for that crucial meet between the Prime Minister and the US President. And there's a lot is talked about it, given the fact that we are talking about there could be some defense tie-ups, energy tie-ups, and some respite coming in for the pharma sector. What's your view? Which sectors should you watch out for in light of this?
So obviously, right, and you also have to mention the fact that so far Trump has not said anything negative about India or tariffs on India specifically, and also the fact that India has happily accepted the illegal immigrants back. So I think we are pulling out all stops not to have any hurdles. I think the budget also, some tariffs were eased, basically putting one on Harley Davidson motorcycles, which was a sticking point during Trump's first term. So I think we are paving the road for a smoother relationship and hopefully extract some benefit on the tariffs that other countries like Canada, Mexico, Europe, as well as China are going to face. So hopefully the fact that Mr. Modi has been so quickly invited is a positive sign. And naturally, from a concessions perspective, I would still back the IT, because I think that's one thing very clear, that America cannot substitute Indian IT engineers yet, because that level of skill, and that's a high-end jobs. And Trump's focus is more in terms of the steel, the manufacturing, the low-end jobs where mass employment in the US, can be created. So I think IT continues to be something that I think India will walk away with some wins there, because it's in services. So there's not so much of that we are not putting any tariffs, or we are not putting any making that more expensive for the US in any way. So I think IT continues to remain something where India can extract value because of a proven thing. And with the AI boom now coming in and America trying to go ahead on that front, I think Indian companies, especially mid-cap and small-cap IT companies, have a huge role to play in the IT consulting space. So overall, I think IT is something that should benefit from whatever aspect of Trumponomics is at play. Similarly on pharma, because China is a huge API producer, and I think tariffs on China will represent opportunity for India to rapidly scale up and do. So I think to that extent, pharma also, and both IT and pharma will benefit from any currency depreciation also, which is an added advantage to that sector. So from purely the external orientation part, I would think that these are two sectors to focus on. But if you then look at from a slightly deeper perspective, right, we also have to remember that problem for India has been its consumption, and the budget and the RBI rate cuts have given a boost to consumption. So that's a pure domestic play, and I think so. This Trumponomics will not affect consumption. So I remain focused that discretionary consumption should ultimately come out a winner after this current set of volatility eases.
Okay, Mr. Subramaniam, this is Snehi also joining in. While you gave us your perspective on the entire IT and pharma space, also help us understand how this entire Trumponomics, like you put it, is going to affect the entire metal space, because we've heard this blanket ban coming in on any imports of metal to US from any country in the world. There's a huge tariff on that as well. Today, our metal index is down 2.5%, Nifty metal. Give us a sense of what you are seeing for the metal index in the metal space going forward, because on one hand, you have gold that's doing its own thing. You have the dollar rupee trade that's affecting all the commodities as well. So give us your sense on where metals you think are headed now.
So I think that from a metals perspective, we have to look at it the fact that India gets impacted because the prices of metal is fixed in the London Metal Exchange, but the demand and supply are very local. So from India's perspective, the steel and the ferrous metals, the demand should be good, because construction and real estate and capex, whether it's government capex or private capex, all of them need steel, need copper, need aluminum. So I think there's a problem on the demand side. Now the prices, the share market prices are getting affected because of the Trump factor. But I still like to believe that Trump uses tariffs as a bargaining tool rather than as an actual implementer. His track record in the few days, you've seen, right? He's put tariffs, they made some concessions, he's pulled them back. So his idea is to basically extract as much value. So I believe that the immediate panic reaction of the market to this tariff will settle right once the reality comes through in a few days on how the exporters of steel and metals to America, how do they respond to this? So I think this is a panic reaction. And I would say that while it's still not yet time to go and buy the metals back, I would say I see that this will reverse fairly soon from the lows that it's come up back again once the reality of countermeasures of the exporters of metals come into play. So I think it's an interesting time to watch. And I would still say that it's just time to wait on the sidelines and observe the sector rather than commit money into the sector at this point in time. But I believe that the bad news is not going to be continuing because, like I said, ultimately, Trump is a very good, hard negotiating businessman, and he will use this to extract better value for America. So that's how this should play out. And so it's better to wait and see how that pans out.
Right, a very hard negotiator. Wait on the sidelines, watch out how things actually transpire for metal sector. Is that what the charts are also telling you, Kunal, when you talk about the metal space?
I think it's a good time to nibble into these metal stocks. Now, I understand that there's been some news flow which has been negative into these metal counters. But then when you look at this, as a price trend, we look at that many of these metal stocks have formed a decent bottom for themselves. You've seen Tata Steel coming back to that 120 marks of 120 levels. SAIL was a stock which is just about grinding on the 100 levels very recently. Jindal Steel, you've seen JSW Steel, etc. These stocks have made a formidable comeback for themselves in the last 2-3 weeks, and that generally is a first indication that maybe the worst could be behind for many of these metal stocks. What's also aiding to this move is the kind of volume sink we've seen into the price trends for many of these names. So yes, of course, today's data would probably indicate that the volumes is pretty much on the higher side. But then if there is no follow through for the next 2-3 consecutive days, that would indicate that this could just be an event day sell off, which is a natural course for stocks to react on the back of such kind of a big news flow. I believe largely the trend for many of these metal stocks is positive, and I think this dip which is happening into these names could be a good buying opportunity.
Okay, let's shift focus from metals to banking now. Naresh, I want to get your view in on the entire banking space because you have the private banks as well as PSU banks. Both of them have been lagging away. What are both of these indices looking like to you on the charts? Nifty Bank and Nifty PSU banks both.
So both of them look interesting for the fact we are seeing some of the names actually show momentum. So you have Kotak Bank trying to make a new 52-week high. We've seen HDFC Bank make that base around 1630, 1650 and slowly come back. SBI is at closer to the 10-12 month lows and trying to make a comeback. So risk reward wise, that is also placed well. And the ones which had fallen have actually fallen quite a lot. So for example, an Axis Bank has fallen from 1300, 1350 all the way down to 1000 odd levels. Or IndusInd Bank from 1300, 1600 down to 1000. So there has been, even in the smaller PSU banks, there has been a 30-40% correction. So overall, in some cases, the correction has been very large. In some cases, we are seeing fresh breakouts. So structurally, both the sides, there could be a trade.
Right, that's about the banking space coming in. Actually, Sunil, I wanted to come to you and talk about the banking space in particular, given the fact that this one is where the valuation seems to be of comfort right now. Correct me if I'm wrong. And if it is so, then which one do you think one should look at? Private sector bank or the PSU bank? Because when you talk about the earnings front, PSU banking names have actually done well. The street has rewarded most of these companies on back of their earnings.
So I would say that the key difference between private sector and public sector, say that the number of good quality private sector banks is more than the number of good quality public sector banks. This is a result of their natural way of structuring and everything, right? So there are a handful of public sector banks which are very, very good, and a whole bunch of them are not so good. But I would say I would expand that basket of good quality banks in the private sector to be a little bit more. That's number one. Number two is the private sector is largely focused on the retail aspect of the business, whereas the public sector banks still rely on business loans to small and medium enterprises, capital goods, and all of that. So immediately on the short term, if you see that there is some pressure on the NPAs at the very retail end, unsecured loans, and those kind of loans at the end. So those private sector banks are a little more exposed to that unsecured bit, will probably show an increase in their NPAs, and there will be some pressure on the NIMs also there. Public sector banks are not showing that because they've not got so exposed to retail. But the problem is for them is business growth, because private sector capex is yet to pick up. So for them to lend a lot to small and medium enterprises, it depends on the capital goods. Now I'm bullish that over the next 6, 9, 12 months, with the consumption boom, capacity utilization improving, the capex cycle will start, and then public sector banks should benefit. So if you have a slightly longer term view, right, public sector, good quality public sector banks are a good buy because they're going to benefit from that. And the second is that all this giveaway, a lot of the money, about 100,000 crores we talked about as the tax giveaway, let's say roughly 60,000 will go into consumption and 40,000 to savings. In that savings, people still rely on public sector bank deposits. So I see that PSBs will face less of a challenge on some deposit mobilization because part of this, people still rely on the guaranteed return that they get from the banks, and they have a much better CASA, branch network and all of that to benefit from that. So from a medium-term perspective, I would say public sector banks, both from these aspects, are a good buy. But for me, the quality of private sector banks, right? I think that is the lower NBFCs and us who are going to get more hit in the unsecured lending. I think good quality private sector banks have good risk management practices, and the valuation gives me greater comfort there. So from a slightly shorter term pick, private sector banks are a better pick for me because of the valuation comfort. But from a medium term, both the CASA flow and the FD flows, plus the pickup of private sector corporate capex over a period of time, makes it the public sector banks will result in greater business and expanding their NIMs over that time. So I think a blended mix of both, depending on your outlook, would be the way to go. But overall, yes, I'm bullish on that. And one final point I want to make is that the 100,000 crore giveaway, while part is going to go to consumption, that's going to benefit private sector banks more because they are more into the retail EMI-based lending, right? But at the same time, they also benefit from the whole shift into the savings. So insurance companies and mutual fund banks are big, private sector banks are big distributors. In the public sector, you have State Bank, Canara Bank, and one or two others who are, but a lot of the private sector banks, whether it's ICICI, HDFC, Axis, you name it, Kotak, are all very big on the distribution side. So they should get a fair share of fee-based income from selling insurance and mutual fund products, right? So I think to that extent, they will get a boost to their income from the fee-based side. So that's why I believe from a shorter term, private sector, good quality banks are a better pick from a shorter term. But if you have a medium-term perspective, then PSUs can also aid your wealth creation.
That's the outlook coming in on private versus PSU banks, and where Mr. Subramaniam's preference lies, largely, if you could call it that. But while we are talking about the consumption space, Mr. Subramaniam also touched upon that space. We have a very important company rather coming out with its numbers just in a few hours from now. That's Nykaa, one of the last consumption plays to come out with its numbers for Q3 earnings season. And here's what we're expecting when it comes to Nykaa on the consolidated basis. Revenue is expected to come in at 2,270 crores versus 1,788 crores, which is up 27% on a year-on-year basis. EBITDA is also expected to grow very sharply, rather 42%, seen at 140 crores versus just 98.7 crores this time last year. Net profit is expected to double, or in fact slightly more than double, if you could call it that, because coming in at 36 crores compared to 16.2 crores this time last year. Margins are also expected to inch up incrementally at 6.2% compared to 5.5%. Now, remember when the company gave their update, they were very positive on the net revenue. They said that net revenue growth is likely to be higher than mid-20s. That's what we are also expecting. Rather, we're expecting a 27% growth on that front. GMV growth for beauty vertical to be in low 30s, and fashion to deliver net revenue growth of around 20%, while the net sales value growth is likely to be around low to mid-teens. What we are expecting in exact numbers, the GMV and revenue growth of 27% each. When it comes to the beauty and personal care, the BPC segment, that GMV we're expecting at 32% and revenue at 38%. For fashion, the GMV, which is the gross merchandise value, of course, that we're expecting just at a 1% growth. So it's actually the fashion numbers that could weigh down on the overall Nykaa's Q3 earnings. And for fashion, we're expecting revenue growth of 21%. BPC should post strong performance driven by customer acquisitions as well as tailwinds from the festive period. Largely, this is what we're expecting. What's going to be key to watch out for when the earnings do come out is the BPC advertising revenue and EBITDA margin improvement, new customer addition for BPC, and lastly for fashion, the NSV growth and the loss reduction. These are going to be some important metrics to watch out for. So keep a close eye on Nykaa's Q3 numbers. They'll be out in just a few hours from now.
Right, absolutely, Snehi. But I hope you've actually kept an eye out on the Nykaa Pink sale. Have you?
Pink sale, Cheryl. Every time there is a sale, my eyes are on the sale. Don't worry.
But the point is, have you purchased some and contributing to all of that or no?
Well, not this quarter. My contribution is not going to be in this quarter, but over the past quarters, I think Nykaa would be very thankful for me.
Yeah,
to have
absolutely.
me as a
But you know,
customer.
Sunil, that's my entire debate that I keep having, you know, within my mind, that, you know, how is it that you'll end up buying quarter after quarter from these places, be it your consumption theme, be it all of these plays, you go to a store, you buy in bulk, and then, you know, quarter after quarter, how do you, as a layman, as a consumer myself, I want to understand the rationale when you look at these companies. What is it that one should actually look out for?
Okay, see, if you look at it from are you asking me as a market share or as a share market perspective or as a consumer perspective?
Consumer perspective, because I know that most of my viewers also are watching this as consumer in a consumer perspective, more than, you know, when they are taking a call to buy into a counter, they are also looking at these counters as a part of being a consumer, right? When you are looking at Mahindra, you're looking at Maruti, you're looking at all these companies, you also look at them in the consumer perspective.
So I think as a consumer, what's changed is, one is that basically the consumer's age has come down. The result of this age coming down is that you're much more, I would say, short-term in your outlook. You're willing to change, try out new products, keep flipping products a lot. Now, whether if it's cars or if it's iPhones or it's fashion, right? You try something, you don't like it, you go back and you try. So you're not willing to stay patient with the product for long. So you're triggering that. So I think the whole quick commerce indicates that, right? Your quickness, you want immediate action, immediate delivery. And 3 months you not like the product, if somebody comes with a new, you are more than willing. So I think the ability to take a risk with a new product, the lack of a longer term perspective in the mind, saying, oh, I didn't like this, let me change, and somebody comes with a better offer, I will easily flip. So I think it's a huge mentality shift in consumers, which is what is driving all of these kind of businesses. And while one can argue that, you know, it's not socially good, but I think from a business perspective, I think this is how Western economies are, right? And we are just now aping them in terms of this buying behavior. And I think from as a market participant, as a consumer company owner, right, I think it's welcome, right? As long as I want every new product to be tried by a set of initial routers there. So I think that's good from an economy perspective. But as a consumer, you can't change them the way they think. They are exposed to so much more information, thanks to Google and Insta and WhatsApp, and people are going to keep trying out new things. And I think that's where the product life cycles are going to be much shorter. We'll keep getting newer products, and that company which can keep the pipeline full with new, interesting, innovative products will continuously walk away with market share.
Right, point taken. Thank you so much for that, actually, Sunil, for enlightening all of us to understand.
If you like this video, then like, share and subscribe to ET Now.